So good morning, ladies and gentlemen. It's a cold rainy morning here in Nairobi, as April should be. KAM board members, esteemed representative from Ministry of Trade, Industry and Enterprise Development, Kenya Revenue Authority, EY, National Treasury, KAM chapter and sector leadership, all protocols observed. Ladies and gentlemen, good morning again. This is Job Ojohi. I'm the head of policy research and advocacy here at Kenya Association of Manufacturers, and I'll co-moderate the session together with Dr. Simon Githuku, who is KAM Fiscal Research Manager. I take this opportunity to welcome you to this webinar session on Finance Bill and Budget Statement. The Finance Bill 2022 and Budget Statement comes with several revenue-raising measures through income tax, VAT, excess duty, Tax Procedure Act, miscellaneous levies, among others. Some measures have been welcomed by the manufacturers, whereas others have been refuted due to their grave impact on the sector. To help us understand the bill and the statement in a panel of speakers and discussants drawn from KAM, National Treasury, Ministry of Trade, Industry and Enterprise Development, Kenya Revenue Authority and EY. I request that after the end of the webinar, you submit your views and proposals on Finance Bill 2022 to KAM legal team to be included into a memo to be submitted to Parliament. The deadline for submissions is falling on 22nd April 2022. The program will run for 2 hours, and to start us off, we will have KAM leadership led by KAM board chair in making a few open remarks. I sincerely pass my CEO's apologies for absence. She's currently on leave. During the rollout of the program, please mute when you're not speaking, especially the panelists and the speakers. Please share questions via chat function, which will be handled through typed or voice feedback, especially to our esteemed participants. So at the moment, and as I've noted that our CEO is not present on the call, I'm going to make a few remarks on her behalf before I invite KAM board chair to make remarks. So Kenya Association of Manufacturers is the representative organization for manufacturing value-add industries in Kenya, comprising of more than 1,300 members, cutting across 14 sectors distributed across the country. In pursuit of our core mandate of policy advocacy, KAM promotes trade and investment at county, national, and international levels, upholds standards, encourages the formulation, enactment, and administration of policies that facilitate competitive business environment and promote the reduction of the cost of doing business. The 2022-2023 budget statement was delivered on 7th April under the theme, Accelerating Economic Recovery for Improved Livelihood. This year's budget statement was read early due to the upcoming elections and for the process to be completed in time for the assent of the Finance Bill 2022 by the President by 30th June. In the statement, the government aims to improve the business climate, promote investment in key sectors such as manufacturing, and close the infrastructure gap in the country. Today's webinar seeks to highlight and break down some of the budget policies and the revenue-raising measures for the fiscal year 2022-2023 and how they are likely to affect the local industry. This is again the backdrop of an economy that is recovering from the COVID-19 pandemic, rising cost of debt, projected drought, ever-increasing cost of goods, and the upcoming general elections, among us. The Finance Bill has already been published, and that's where I stated that KAM is receiving its views from the members, from her members, so that we submit them to the Parliament, whereby we will defend counter proposals on the bill accordingly. So the government, through the Finance Bill 2022, has proposed the introduction of both tax and administrative changes to several laws. The tax measures are geared at increasing government revenues collection at the expense, it seems, of eroding tax incentives and benefit that would otherwise, among other things, form part of the backbone for the post-pandemic economic recovery phase. We shall be summarizing the key tax proposals and the implications of the proposed policy measures on the manufacturing sector. It is our belief that the key to achieving projected economic growth will be greatly determined by how the government balances revenue mobilization, expenditure rationalization, public debt management, and other externalities. I welcome all of you and wish you a fruitful deliberation, and again request that we receive your feedback via email here on the chat, so that we can consolidate your views into a memo that we're going to submit. At this point, I want to welcome KAM board chair so that we can make also his introductory remarks.
Yes, good morning, everyone. Just to confirm with you, Job, my audio is fine?
Yes, your audio is fine, Chair.
Okay, excellent. Thank you, Job, for the introduction. Thank you, members, for attending. I know there have been quite a number of these seminars on the budget as they are usually, so we really appreciate everybody who's logging in. And this one is more specific, I think, for manufacturers. So we'll be quite focused on the manufacturing issues that are discussed. So our special welcome to our guests. We have from the Ministry of Industrialization, Director Stephen Odua. We have from the Treasury, Joseph Ngugi, otherwise known as JZ, as we popularly know him. We also have from Ernst & Young, Hadija, and Robert Miner, who've been generous in agreeing to participate in this. And of course, my co-director at KAM, Mihir, who will also be speaking later on. And all the other guests who've joined us as we discuss these issues. Mine is a brief introduction. I think the technical people will give you a lot more detail around the tax measures and the implications. And we also want to hear from the members in the question and answers and their contribution to what these issues will mean. So just painting a big picture is to see that these were not easy times to be making a budget. In fact, I, at some level, feel some sympathy for JZ and the rest of the budget team, because this could not have been an easy budget to make. Job has already noted we are in an election cycle, therefore even the time to make the budget was reduced, and even to discuss it is going to be kind of condensed. And so we also need, as an association, to move quickly in getting our opinions and our views put in good time. But we're also coming out of a pandemic, if at all we are coming out of it. If you are reading the global press now, it's not going very well in Europe. It's going very badly in China. I think this morning I saw the number of ships waiting outside Shanghai because they've closed it down. And as we realized in the previous cycles, the immediate shock is there, but it's going to take a couple of months before we realize what the implications are. Because if you had shipments coming out of Shanghai now, you're only going to run out of stock maybe in June or July, depending on how far you are. So we expect it's going to be a difficult time going forward. Then, of course, there is that little incident between Russia and Ukraine, which has totally reshaped the world, and a lot has gone on around that in terms of even sanctions, food supply, fertilizer supplies, oil prices. So that little incident is causing huge repercussions across the world, some of which are unknown. We can see some of the immediate ones, but we are still waiting to see. It is a developing situation. So it is also an uncertainty we have to look at. And finally, although this week maybe we'll see some changes, is the poor weather we're experiencing. Kenya is largely an agricultural economy. And if we don't get good rains, we are going to have serious pressures on our food supply, which also reverts to foreign exchange, because if we have to import food, we're going to have to spend foreign exchange on that. And this is at a time when food supply globally is also highly challenged. So we know the pricing of food globally is a big issue. And so these are difficult times, difficult contexts within which to make a budget for our country, even for our own businesses. For ourselves, we can realize these challenges are real. Having said that, it's not the end of the world. People are going to continue. There are difficult circumstances, yes, but again, we have shown our ability to be resilient, our ability to adjust to the times, and our ability to innovate and to start doing new things that are going to help us even through these difficult times, to enable us to survive and prepare for a future in which we can thrive, because circumstances may be difficult at the moment. Of course, also for the current government, it was their last budget, so I suppose there were also some pressures there around finishing projects and so on. But I think, speaking broadly, what we didn't see ourselves is the understanding of the difficulty and the situations that are out there. The CS did mention that the budget was going to try and ease food or costs for consumers and make things a little bit easier. But, you know, for us, what we want to engage with is today is actually what was actually in the bill and how that will translate. As with every bill, and we are grateful for those, we get occasional wins. We get some things which are useful for us that we've been discussing over many years, and those we are thankful for. We'll hear more about them. Again, just to highlight, one we are really looking forward is a national taxation policy, because that's been something that has been discussed for the last so many years, and it's a real part of what we are pushing for, because it's important for industrialization, for people to have a clear understanding of the direction tax is going. When you're investing in manufacturing, you're investing for the long run, not just for on a year-on-year basis. So it is important to understand what the taxation policy is going to be in the future. We had a few new exemptions for IDF and RDL for the pharmaceutical sector and other benefits they got. And those are actually useful. But again, coming with those, we say if they are useful for the pharmaceutical sector, they are useful for all other manufacturing sectors. We understand they're there to make the cost of goods and the cost of producing in this market globally competitive. Because at the end of the day, manufacturing has to be globally competitive for us to be able to be sustainable in the long run. So we welcome those changes, and we hope they are going to spread even further to other manufacturers. We still have challenges which we had presented to Treasury, to our ministry, and also to KRA that we feel need to be addressed, and we'll still be raising them. Interest deduction, the restriction on interest deduction, for instance, remains painful and difficult, especially as we look forward to a post-COVID recovery and reorganization of global markets. We need to encourage investment. And this restriction to 30% of your EBITDA is quite difficult for investment, especially when you're making heavy investment at the beginning. So we hope that that can be spread broader. Excise tax. Although the CS talked eloquently about shielding consumers, the use of excise tax on even more products is not going to shield consumers. That's the bottom line. It is a cost that will end up in the product. It will end up in consumers' product. So we are saying, even especially at a time like this, when inflation, the cost of goods, the cost of raw materials is rising, this is a time when we would have been holding back on issues like that. And I'm sure there'll be some discussions around that. We had a new surprising change on a deposit of 50% required for tax disputes that are appealed beyond the tax appeal tribunals. And again, that is going to be very demotivating for taxpayers. One of the questions that was asked was whether we will ask KRA to do the same, because actually at the moment, KRA seems to have most appeals from the tax tribunals. I don't know whether they'll pay us some money before they move forward. But generally, I think it's just probably not good practice. And especially when KRA, we were welcoming the idea of it becoming a revenue service. So the revenue service is going to be the actual service that is delivered. So if you make life harder, we will not believe that you're actually a service. You become still an authority and not really developing with us good relationships. Like has been done in the past, we've actually developed a lot on the ADR side, avoiding going to court by dealing with the tribunals and so on, so that we can resolve matters quicker. So we are hoping for proposals that will help us resolve matters quicker, because we will have disagreements here and there. Resolving them quickly is important, which we all support. But making them punitive to resolve will not add to the speed of their resolution, but will actually make taxpayers even more aggressive in their disagreements with KRA, which is probably not what we are trying to look for. Finally, I just want to highlight some of the things as we will be discussing the Finance Act to measure them also against the manifesto that KAM came up with. We've been discussing this with the political parties and the public at large, and the issues that we think need to be addressed. And I leave it to you to judge how well we are doing against that. But it's also how our advocacy is going to be, again, when we're discussing the Finance Act, is supporting things that are aligning with this and maybe lobbying against those which are not really aligned with us. And we see a couple of things that we thought are very important for us. One is, like Job has mentioned, is the deficits and the debt management. As the taxes have been rising and we see a big hunger for taxes more and more, we start asking ourselves, where is this money going to? Why is all this money being collected? Because it's a question we must ask also, where does it go to? And we think there is a lot of to be done. Traditionally, we've not discussed the expenditure side of government, but now we need to, because it starts becoming our cost when the taxes have to rise and so on. So we've put out a position that we really need to manage government expenditure, reduce the deficit seriously, and be very astute, or we're going to have to be very creative on how we manage our debt, because the demand on the cash flow of government is generally not going to be sustainable, especially if we want to grow manufacturing. We think our key priority is going to be creating jobs. Jobs and livelihoods are what the next government must do, because even as we pay more taxes and want to grow our economy, it's going to be around jobs. Jobs and wealth creation have got to be key priorities. And we've got some suggestions around that. Investment is going to be key. And that's why, again, like I said, we look at the finance bill, the taxation policy, and start saying, is this pro-investment or is it stopping investment? Kenya is not a country where we've been seeing a lot of investment. For instance, FDI is just around 1.82% of our GDP, while we have other countries at 6%, some even above 20% of GDP in investment. That tells us we are not competitive. We are not attractive. We are not attracting money into our economy, and therefore we cannot grow. In the long term, if we cannot get people to invest here, we will not be building the building blocks for economic growth in the future. We need to develop our exports, and we hope that we will actually get some measures that encourage exports of goods. Yes, we have a market, and we applaud government for Build Kenya, Buy Kenya, Build Kenya processes. But for us to build a really strong manufacturing base, for it to get to our goal of 15%, as it was in the Big Four agenda, we need export markets. Export markets are huge. So Kenya is, at the moment, I think we are about 1% of the global economy. So if we think about just even the African markets, and we applaud the work done around EAC and COMESA and the Africa CFTA, if we can grow those markets, we have a real opportunity for manufacturing. Because the things we're making, we must find markets for them. And no other country, I think, even historically, has grown without an export market or an export focus, especially in manufacturing. So that must be a key thing, and we must remove the impediments that stop us from exporting. And the final two is our regulatory review. We really do need to bring our regulations together, try and minimize how many there are. We'll be looking at whether we are getting additional and more complicated regulations that do not help businesses, whether manufacturing or other areas, because they get too much paperwork, too many regulations, and often also contradictory regulations where we are not sure what the applicable regulation is. I keep saying whenever a new regulation is put in, we should think about deleting one or two others. In fact, ideally two others, because we've put in this new regulation to resolve those issues. And finally, getting government to deliver on key services that are important for us. One we've highlighted is soft infrastructure or non-hard infrastructure. So we are saying we've built roads, railways, and all that visible infrastructure, but there's systemic infrastructure that we need. Things like water, things like sewers, things like traffic management. These are soft things. They're not very easy to see, but it is infrastructure that is crucial for us to develop our economy as we move forward. So thank you very much. We look forward to good engagement and contribution from our members. And we also welcome the government to hear their perspectives also on these issues as they engage with us. Enjoy this morning as we go ahead. Thank you very much. Over to you, Joe.
Thank you, Chair, for that great presentation and the remarks that you have made as far as this webinar is concerned. Looking at the whole how we can address the issues of competitiveness and how we can attract investments into the country. It is of great interest because it's through this that we are going to drive job creation in the country. At this point, and thanks so much, Chair. At this point, I want to invite Mr. Steve Odua, the Director for Private Sector Development, State Department of Industrialization, to make his statement on the Budget Statement 2022 and its effect on the manufacturing sector. Karibu, Mr. Odua.
Thank you very much, Job. Good morning, Mukai Kunywa, Chairman, sorry, KAM Chair, KAM Directors, CEO, ladies and gentlemen, good morning. It's always a pleasure to join in this webinar, which is becoming a tradition, but very, very important for us to take stock on in particular, how the budget relates to our manufacturing initiatives, both in terms of government policy and also in particular in terms of facilitating you, the manufacturers, to be able then to work better. As we are all aware, we as government are supposed to try and see as much as possible to provide a good enabling environment for you to then thrive, grow, and ultimately then we be able to meet our goal of improving our economic growth, job creation, and also wealth, as it were. So with regard to this particular budget, as the chair has mentioned, it comes at a very interesting time. Interesting in the sense that we're just moving away from COVID, but also in particular, we also see emerging issues, global issues coming in. A case in mind in particular is now the ongoing war in Ukraine. As we continue operating in one global village, we note then that initiatives that or challenges that occur in one part of the world are more increasingly affecting other aspects of the world. Another case in mind is issues of climate change. The chair has alluded to our possibility of seeing a challenge with rains not regular, though today we see them coming in. And that then could also affect especially our manufacturing sector, which is agro-based in terms of the biggest contribution. So back to the budget in terms of what then we see as the wins. There has been continuity in terms of policy with regard to the Big Four agenda. As it were, the manufacturing pillar, where we fit in, got 10.1 billion. We see the biggest sector or pillar within the manufacturing sector was the universal health coverage, which got 62.3 billion. But just like I've already been alluded to, we are not off the hoods completely 100% with COVID. So we need to prepare in case there's a resurgence. So we need to put in place measures. And I think that's where the focus will be in terms of that big budget within that particular pillar. So in terms of the manufacturing pillar, if I just break down, continuity has been provided in terms of developing the special economic zones, which are a big change, game changer, the way we see it in government with regard to facilitating investments within this sector and huge investments at such, creation of clusters, where then we could see skills improvement or skills growth within those cluster arrangements. And a lot of that budget that has been provided within the manufacturing pillar is basically going towards continuing or completing some of the SEZs that have been started. Case in particular being the Dogo Kundu and the Naivasha that has gone quite a huge step in terms of providing the infrastructure for the investors now to move in. Again, in terms of enablers, we see that this budget has also been supportive to the manufacturing sector. In case in mind, coming in also quite strongly is the issue of digitalizing the economy. As we are all aware, we are trying to move towards the fourth industrial revolution, and ICT infrastructure improvement in terms of creating that enabling environment for that to be able to, for us to be able to move into the digital economy becomes very important. And it's also coming at a good time when we also have the ICT master plan, which would be a critical enabler for the manufacturing sector as we move towards the digital economy, or as we continue growing in that particular sector. The other issue I see as a big win for the manufacturing sector is in terms of the continuity in infrastructure development in terms of road, rail, but I would want to single out energy, where 95.05 billion has been set aside, and in particular to improve the national grid system, taking the largest share. Until quite recently, the focus was more on generation, but for maintenance of reliable electricity, we need then the national grid to be also modernized, to be upgraded, to reduce breakdown. So that is a welcome for the sector as far as we look at it in the policy sector, that will help then ensure reliability and availability of energy, which is a critical factor for the manufacturing sector. Again, alongside that, there's the issue of also putting a bit more in terms of geothermal generation, as also building the capacity of our generation. And again, it's in line with our policy of going green in terms of energy usage. So that I think is another aspect we're going to single out as a plus or a positive for the manufacturing sector. So drilling down a bit to a bit of the specifics, we also see the amendment of the income tax, and I would want to single out aspects of definition and also bringing out multinational enterprises. As you are aware, we want to be a regional hub as a country, so that as we attract investors, we want to see that issues of double taxation are properly addressed or are avoided. As we move into international agreements, as we try and expand our markets in terms of export markets, but also see how we can attract even investors. We want to see that the amendment of the income tax is trying to address that particular aspect, which would help improve avoidance of double taxation, and also improve our status as a regional manufacturing hub. The other issue that I see in terms of VAT, I think Chair has already alluded to, one of the big winners are the pharmaceutical sector, where a lot of products have been zero rated and excluded from VAT. Medical oxygen, again, in preparation of COVID, as I've mentioned. And for us, a big win as a ministry is efforts to enhance our automobile or automotive policy. The National Automotive Policy, which we recently launched, got a bit of a boost in terms of VAT of the inputs and raw materials for the motor vehicles. There's also for the locally manufactured passenger motor vehicles. Again, this is towards our Buy Kenya, Build Kenya policy. So this we also see as very positive towards addressing or implementing that particular policy. In terms of excise duty, I know a few sectors have been hit. The fruit juices, for example, the cosmetics and beauty products, bottled water. But then the good thing in terms of motorcycles, for the locally assembled motorcycles, they're exempt from excise duty, which we hope will then see improved local production of motorcycles, which, as most of you would agree, are quite a number in terms of usage all across the country. In terms of availability of raw materials, we have seen specific duty on the export levy for hides and skins, so that we can to further discourage exports of that raw hides and skins, so that you can have the raw material locally processed for goods locally. The same also with the scrap metal, 20% levy, or export levy has been put on it. Again, just to make our special economic zones more competitive, we see there's been deliberate effort to exempt them from IDF. And also in terms of facilitating the sector, the exemption on financial services is a good takeaway, as it will help in terms of, again, promoting the digital economy, which the manufacturing sector is a key player in terms of moving towards the fourth industrial revolution. So I know as we continue in the webinar, we'll get to have a bit more details on specific subsectors. So I'd wish to just leave it at this general level, that indeed, given the circumstances, and as already been mentioned, that we are having this budget, it has been relatively quite good for the manufacturing sector. We have not seen increase of taxes as much as is a lot of demand for revenue. But we hope then things may better improve in terms of the global economy to support the measures put in the budget. Thank you very much, and over to you, Joe.
Thanks so much, Mr. Steve Odua, for that great presentation, covering a wide range of measures that the government has taken place through the statement and the finance bill, the support that's coming to the SMEs, the special economic zones, EPZs, the river tax and whatnot. So we look forward to work together with the ministry to ensure that there is effective implementation of these proposals that are coming through the budget statement. At this time, I want now to invite Mr. Robert Minor, the Senior Manager, International Tax and Transactions Advisory in Ernst & Young, LLP, to take us through the implication of the proposed tax policy measures in the Finance Bill 2022 of the manufacturing sector. It's your turn, Mr. Robert Minor.
Thank you, Joe, for that introduction. Let me just present. This one. Sorry. Okay, thank you. Yeah, I trust this is visible to everyone. Thank you very much, members and attendees, for joining this session. And it's a pleasure to present to you some of the measures that have been passed or proposed in the Finance Bill 2022, and particularly those ones that are likely to have an effect on the manufacturing sector. So today we are going to highlight the various measures that have been proposed, either amending the Income Tax Act, the VAT, TPA, Excise Duty Act, or the Miscellaneous Fees and Levies Act. To start off, the first measure that we have is the introduction of the definition of the term fair market value. This is meant to mean that you will have comparable prices that are open, that are available in the open and restricted market between independent parties that are acting at arm's length and under no compulsion to transact. This is obviously meant to bring clarity, because you know, for instance, in the banking sector, we have the issue of the forced value, market value, where the bank can impose a value on a property. So this is to make it clear that for tax purposes, it has to be the open and what it should be transacted between two parties who are independent. When you review the Income Tax Act, for instance, you realize there are a couple of instances where this term is used. For instance, when you're determining the taxable employment benefit, where an employee is granted premises by an employer, they refer to the fair market value being the value of the benefit that should be subject to taxation for employment tax purposes. So those are the kind of things that are meant to be addressed by this definition, among others that are defined in the Income Tax Act. The other one, which is obviously very critical to investors in the country, is the fact that the bill proposes to increase the capital gains tax rate from 5 to 15%. But it is worth noting that in 2019, we had a similar attempt to increase the rate to 12.5%, which was dropped before the bill was enacted into law. Certainly, while the Revenue Authority is seeking, and the National Treasury is seeking to raise additional revenue, what we'll be looking for is, for instance, the National Treasury considering an indexation allowance. Because, for instance, if you've been holding a property or certain for, an asset for 25 years, inflation has eaten into the value. So you're not getting the real value when you look at the benefits by just comparing the sale proceeds vis-a-vis the purchase price that you might have spent 20 years ago. So what maybe stakeholders need to push is for an indexation allowance, if not dropping the proposal altogether back to 5%. But it's worth noting that in the region, Kenya is actually the lowest. Looking at the other countries, they actually tax at the same rate with the business income. So if we manage to get this retain at 15, maybe indexation would be the best bargain. The next one is on DST. KRA appears, or the National Treasury appears, still hell-bent on ensuring that this is remains. And so the rate is proposed, they propose the rate to be increased to 3% of the gross turnover. What then they have put in place is the fact that an non-resident with a PE, meaning if you have a branch in Kenya, then you'll not be required to account for DST, basically because you'll be expected to account for your, you pay corporate income tax on your profit, and even at a higher rate, because that is 7.5 for a branch. This is obviously expected to increase the revenue collections, and I'm sure KRA has done some monitoring on what has transpired since the introduction of DST, and they can have some predictability in terms of the expected additional revenue. However, noting that the country, and we've had a number of provisions that point towards that the fact that Kenya is adopting what is happening globally, we know that under the current two-pillar project being led by the OECD BEPS project, it is a requirement that all countries should drop all digital service taxes and related taxes. But Kenya, among about 6 other countries, I think in Africa we also have Nigeria. Those are the countries that decided to adopt a wait and see attitude instead of signing the agreement when that came into force, or when that was being signed last year about July. Kenya took a wait and see attitude. So they've not signed the agreement. And I think there's a reason why they have the energy and they feel they can actually increase the rate, because if you sign that agreement, you should have in place plans on how you're going to abolish DST, because the two-pillar project will bring about the issue of the minimum tax and other taxes to make sure that you're well compensated for the fact that if a country is contributing to a many which is operating in this space. So we will to see how Kenya will maneuver the pressure from the international community and the fact that there are just a few countries that have not adopted this. Then the other one is deductibility of forex exchange losses. This is meant to align the deductibility of foreign exchange losses with the introduction of a thin cap, which is based on EBITDA. So we know in 2021, the law was amended to the effect that for the in terms of deductibility of interest expense, you need to consider your EBITDA, and where your interest expense exceeds 30% of your EBITDA, then the excess is not deductible for income tax purposes. However, the provision that was addressing the issue of the forex losses was not aligned with that amendment. So the law now seeks to align the deductibility of forex losses with that provision which was brought in place last year. It is, however, worth noting that there are a couple of things that will be a bit of a pain to taxpayers who are affected by this, because one, previously the issue of forex losses, they were restricted to intergroup loans. As the law is worded, it would actually mean all forex losses, irrespective of whether they relate to intergroup loans. So any loan, even that you have from a bank and you have forex losses, and then you are caught by the 30% EBITDA, then that again would be deferred until you are out of that. The other thing, and I think which is critical and why it's interesting, because KRA adopted this from the OECD, the base erosion project. But when you think about the local companies, why you'd want to restrict a company which is paying to a local financial institution, it doesn't make any economic sense, because the same bank in the country or the financial institution, you still pay corporate income tax on the interest. So I think the need here is to push for lobbying to make sure that this EBITDA does not apply wherever you're paying interest to a local financial institution, because anyway, that bank or SACCO or whichever financial institution you're paying to will be liable to pay corporate income tax on the same interest. So it is actually a double benefit to KRA, where you restrict on one party, yet the other party who is receiving that income is actually paying tax on it. So that, I think, should be one of the lobbying points that one should come and the other parties should be pushing for. The other one is on the deductibility of donations. What we are saying is that previously donations were only deductible when given to specific bodies which were defined. You had to be registered under the NGO Act or the society, exempt from registration under the Societies Act. And I know KRA has attempted or has used that provision to try and restrict donations given to foundations. We know foundations have become, there are many, they've become the norm for very many corporate organizations. They have a NAM, which is operating as a foundation, which is used to give funds to these kind of activities. So that was being used to deny that kind of benefit. But the law now has come in to make it clear that as long as you give it to a charitable organization which is exempt, and the fact that is that those foundations, most of them have actually the exemption certificates, then that will be deductible. So that technicality should be a thing of the past if the law is passed as is. Then the other one is country by country reporting. Again, another adoption of what is happening globally, that multinationals will be required to file within 12 months of their reporting date a report detailing certain information which is highlighted in the law. The National Treasury published draft regulations last year. However, we've not seen the implementation of this. It then appears that the National Treasury has decided to actually now bring these regulations into the main act, the Income Tax Act, because more or less what was in the regulations, the draft regulations, is what now you find in the main, being proposed to be brought into the main registration. So yeah, that's the requirement will come in as long as you are within the threshold, or you're within, you're either the parent company or you're a constituent entity. Then you'll be required to file that level. And this is additional reporting, I think, for anyone who be under this, there will be quite a bit of reporting and disclosure that will be done to carry. Then there's an amendment of, in terms of amending the VAT return, for how long you can amend the VAT return. I think we've had controversy on this. Taxpayers who are saying, if I amend the return 3 years down the line and I'm claiming an invoice which is within 6 months of that date, of the return date, then I can, enjoy the input. But I think KRA has realized that might complicate stuff, particularly considering that they are rolling out teams and they might want to close historical periods faster. Then they are saying you can only claim within 6 months of the tax period in which the supply or importation occurred. So that makes it very clear. It's within 6 months of the supply. So if you amend the return and it's so much in the historical past that, then that input VAT will not be eligible. Then in terms of refund, we've had a lot of outcry in terms of taxpayers who are seeking for refunds, particularly following the introduction of or enforcement, because Section 47 was actually introduced in 2015, but KRA started enforcing the same about 2 years ago. So what these amendments proposes is that taxpayers can now apply for the utilization of the overpay tax to be offset against your future tax liabilities, instead of seeking for a cash refund, which we know is almost impossible. It takes a lot of time before you get the same from KRA. Then you can seek for that utilization of the refund to offset against your future taxes. And also key is the fact that for installment taxes, which are pretty clear even when you go to iTax, that I paid my installment tax. If you have overpaid, then the same will be utilized to offset against your future installment tax liability. So if I overpay in 2020, then in 2021, it will be utilized to offset against that installment tax. And we know this has driven very many taxpayers to adopt the current year basis when they are paying their installment taxes because of the fact that they know they have to go for a cash refund, which will take forever before they get that cash. Then the bill again seeks to introduce in the TPA a provision that where you are saying if you have paid tax in ELA, in case where the supply is exempt, so you have a supply which is exempt or zero-rated, but due to certain circumstances which are beyond your control, you are not able to get the exemption of the zero rating. So the law will now enable the KRA to process that refund without them deeming there to be a technicality or lack of enabling registration to give them that opportunity of seeking that refund, which is a good step because of we know sometimes the bureaucracy in government might frustrate your efforts, and by the time you get certain exemptions, then you have you've already probably been charged VAT. So it's a good step. The other one, which is pretty painful for every taxpayer, is the fact that the KRA now, or the National Treasury, seeks to ensure that you deposit at least 50% of the disputed tax in a special account whenever a dispute has been determined at the TAT. While we note that there has been tremendous progress in the resolution of disputes, and the fact that the TAT has by and large been very objective, I think Kenya is one of the countries we have in East Africa where we have a tribunal which is extremely objective. I mean, the members of the tribunal are largely objective, and decisions are actually made on merit and without fear or favor. I mean, this obviously is a huge burden to taxpayers. And I think for any taxpayer who may not be having this kind of cash, then this may jeopardize their ability to appeal at the High Court. In the worst case scenario, I think if this has to be retained, I think maybe what taxpayers should push for and is probably having a sort of a security, or some sort of security that's placed other than the cash, because cash might become a big hindrance for some people to manage to. I mean, if you have a huge dispute running into billions and you're told to deposit 50%, then it becomes a big nightmare for most taxpayers. So security in terms of maybe a letter from a bank or something could be maybe the better option in case this has to be retained. The other one is on a digital marketplace. The definition is being amended just to make it clear that the same applies on sale of goods or provision of services. So this is just to minimize or avoid any ambiguity in that. But the same also makes it clear that for dealers, if you're importing digital services, then you don't need to account for reverse VAT. So it's not a case of, because reverse VAT is largely a cost to the importer. So you don't need to account for that because then they'll be paying the 1.5%. Then the threshold, we have had a lot of debate again as to whether if you're a supplier on digital services, then whether they need to have the 5 million. This is set to be struck out. So even if you're supplying 100,000 Kenya shillings, then you'll be subject to DST. Then the other one is on claiming of input VAT. So we are saying that you'll be entitled to claim input VAT after you file their VAT return. And the bill also says that the commissioner can request any other documentation for purposes of validating input VAT. Obviously, this is to encourage taxpayers to file VAT returns on time, as well as if you look at the ongoing controversy on VAs and the missing trader, KRA has been requesting taxpayers to provide additional information to support the input VAT. For instance, they were requesting for bank statements, goods received notes, literally just showing that you actually incurred or you actually received certain goods and you actually paid out that cash in to the supplier. But this has been challenged on the basis that the law only refers to the tax invoice, that the only document you need to maintain is a tax invoice. And I think this is a wake-up call to taxpayers to make sure that they can actually support what they incur using other documents other than the tax invoice. Then these are just some of the goods where there's a change in the status. For instance, we are saying that taxable goods or services which are being used for direct and exclusive use in the construction of specialized hospitals, then that is moving from exempt to 16%. It's interesting to see that this is happening. I'm not sure if this was targeted at a certain project that might have been ongoing, and then there's a policy change back to 16%, because we still know that the cost of healthcare is still high, and the government has decided to, levy VAT on those supplies. The other one is the supply of maize, flour, cassava, wheat, among others, that we are saying for a period of 6 months, they should be zero rated. Thereafter, then that will revert to standard rated. Obviously, this is meant to be an immediate relief to consumers. However, after the 6 months, if there's no further amendment, then the real impact of the increase in prices will be felt. Then the other change is obviously, which is welcome, is the fact that plant and machinery of chapter 84 and 85 that are imported by pharmaceutical products, manufacturers of pharmaceutical products or all investors, then that will be exempt. Medical oxygen, as well as urine bags and other medical equipment as listed there. So they're all moving from 16% to exempt. However, the key thing and the key observation is whenever goods are exempted is the fact that the related input VAT is actually an expense. It is no longer a case of you claiming a refund of tax. So basically that cost will actually be expense in your P&L, and eventually that is likely to increase the cost of goods. So whenever possible, zero rating is always better, but I know government is also cognizant of the fact that a refund is still a pain for government. They've still not made money to process all refunds on time. So it's a give and take. The other one is the supply of protective apparel, clothing, and all fire equipment, firefighting equipment. The proposal is again to introduce VAT on them. Again, I mean, when you supplying to the country government, you're still supplying to the government. So it's in a way government imposing VAT on itself. So it's one of those things that they might need to look at. The other one is inflation adjustment, where we are saying that the commissioner will be empowered to exempt from inflation adjustment certain goods based on the social and economic environment. So for instance, this year we have a lot of complaint of the high cost of living. So the commissioner would have the power to exempt certain goods. And the fact that they've now aligned the date to make sure the adjustment is done on the 1st of October. But then considering that the main objective of KRA is correcting tax revenue, there's obviously a conflict of interest. I'm not sure how amendable the commissioner will be to exempt goods, particularly the ones which are critical contributors to the tax revenue, from inflation adjustment when they have a lot of pressure to correct cash. So it's a really tough act, and I think the commissioner will be very hesitant to, actually exercise their discretion at this point because of the pressure of collecting taxes. The other one is just goods that where we have a lot of movement, increase basically in the excise duty rate. So yeah, the rates are pretty high. The increment, some of them are more than 10%. So it's a bit high, and I think it's the high time the government considers, probably trying to be moderate in terms of some of these increments. But yeah, generally it's a pure increment in the rates. The others, I mean, the only new introduction we can talk about is the ones that are affecting advertisers on issues to do with the alcoholic beverages, betting, gaming, where now the media houses will be expected to levy excise duty on their invoices to these manufacturers, for instance, the alcoholic beverages. So that cost will obviously again flow down to the consumers. But otherwise, the rest is largely to do with the increase in the rate and a few introductions, here and there. So then the other one, exemption from excise duty, a few exemptions after outcry on fertilized eggs. Then that there's a proposal to exempt that. Natural spirits, which is being used by pharmaceutical manufacturers. And I think this time we can say pharmaceutical manufacturers have done proper lobbying, or they've enjoyed the day. They've had a couple of good proposals in the bill. Then locally manufactured passenger motor vehicles. Again, that's another proposal to promote local manufacturing of vehicles. Then the last but not the least, we are saying exemption from railway development levy and IDF. Again, the same sector. We are saying for importers of manufacturers of pharmaceutical products, upon the recommendation, then they will be exempt from both IDF and RDL. And that's it. Back to you. Yep. Thank you very much.
Thank you so much, Robert. You have really taken us through that presentation very well. The issues are very clear. Where we are winning, where it seems to be a loss for the manufacturers, where there is an exemption that is going to a specific sector, not to all sectors, like when you're talking of the IDF and RDL go to the pharmaceutical sector, the interest is go to all the sectors. In had the chair of the board making the comments towards that direction. So thanks so much for this for that presentation. And when I look at my watch, we are at 11:02. You have edited your presentation very well. You're supposed to edit at 11:03. So giving me 2 minutes to comments. So at this time, I'm going to invite the panelists, welcome all the participants to again field their questions in the Q&A platform. And also introduce my co-moderator, Dr. Simon Githuku, who is going to answer some questions and as I handle others. So the rich panel of discussants includes Mr. Mihail Shalishaza. He is a KAM director and Trade and Tax Committee member. We'll also have Mr. Stephen Odua, Director of Private Sector Development, State Department of Industrialization. Coming on board also is Mr. Joseph Z. Goge, or JZ, Senior Deputy Director, Macro and Fiscal Affairs Department in the National Treasury. Also Ms. Hadija Nanyomo, who is partner in Direct Taxes, Ernst & Young LLP. KRA representatives. We have Ms. Josephine Mugure, Chief Manager, Corporate Policy Unit, Dr. Bernard Kirui, Manager Corporate Policy Unit, Mr. Ephraim Munene, Manager Policy and Tax Advisory, Ms. Nelly Okwach, Manager Technical Support Policy. They are all present. So I'm going to request that they switch on their cameras, also their microphones accordingly once the questions are being fielded. So the first question goes to Mr. Stephen Odua, who earlier made some statement on the budget. Mr. Odua, what would you consider as wins for the manufacturing industry in Kenya based on the budget statement that was read CS Treasury on 7th April 2022?
Thank you very much, Job. Indeed, like I'd mentioned earlier, part of the big wins, support to specific sectors, in particular the pharmaceutical sector, support to local manufacturing, automobile being one of the biggest winners here as well as a pharmaceutical. Again, I would also see as a big win some corrections on some areas that we had challenges in specific sectors, issues like food supplement, issues like edible oils, and issues like especially the iron and steel industry, which is critical for the construction industry, and which we are also having as one of our pillar of affordable housing. So those are some of the big wins. Of course, for us, as we try and promote the special economic zones, it's also a big win in terms of the exemptions, RDF, IDL, and also aspects that deal with funding for the public developed SEZs. So those are some of the immediate wins I could talk about, amongst others. Thank you.
Thank you so much, Mr. Odua. We go to Dr. Githuku.
Thank you, Job. I hope you can see me and hear me.
Yes.
Yeah. My questions goes to the KRA team on the call. We have Ephraim Munene and Dr. Bernard Kirui. Any one of them can feel free to respond. And it is on SMEs, which is a government policy to promote their growth. And considering that we have finance bill Are there some of the proposals that KRA would consider to support the growth of SMEs, particularly those in manufacturing and other sectors? Any of you, Ephraim, Munene, and Bernard, kindly feel free to respond. Dr. Kirui?
Yes, thank you, Simon, and the KAM team and the EY team. First, one of my colleagues, he's supposed to be a panelist. I think she has not. She's joined, but she has not been upgraded to panelist. So maybe Josephine Mukure. So maybe to address the question you asked, there were a number of tax policy measures that were proposed by the bill aimed at supporting the SME sector. One of them was touches on the financial sector, and this was the exemption of microfinance institutions from interest restrictions. That is the EBITDA requirement. And the second one was on investment deduction allowance relating to the generation of electricity, whereby initially it for one to qualify, there was a requirement that the electricity generated has to be distributed through the national grid. But now this requirement has been dropped, and therefore electricity generators that are producing electricity, especially the SMEs, and they are not in the national grid, will qualify for the investment deduction. And I think this is an incentive that will really spur investment in this area and will support the government, or will support the country towards meeting its electricity requirement demands. The third one is on VAT Act, and this one, the VAT registration threshold, which does not apply to persons supplying imported digital services over internet or electronic network or through a digital marketplace. So they will not be required to meet the threshold. Yeah, so the requirements for the threshold will not have been for the threshold will not apply in that case. So I think those are the ones I can mention for now. Maybe I also invite my colleagues to add on others. Thank you.
Thank you, Bernard. Any addition from Ephraim? If none, over to you, Joe.
Thank you so much, Dr. Gifuku. And at this point, I wanted to invite Mr. Joseph Zedgo or JZ to answer on what were the key guiding factors considered while proposing tax measures contained in the Finance Bill 2022, the key principles that were used as key guiding factors. Mr. JZ.
Thank you. But I just want to give clarification because I could hear I don't know what we call it, misinterpretation of what is in the finance bill, which I think is time we need to clarify so that people get the correct information, if we allow. One is on maize flour, which the person who was presenting has said that the minister intended, or the bill to intend to bring VAT on wheat flour, maize flour after 6 months. I think the person who read that may have read it opposite, because the bill read, if I read, in part by deleting the following, this has been deleted. So what has been deleted means cease to exist. And why it has been deleted, this was a provision which came in when the government wanted to bring maize flour under exemption. And the discussion was, please allow us for 6 months and then become taxable. When it was done that provision was supposed to be deleted. But now we have 2 provisions under the VAT Act, which now provide for zero rating, because we were to have 6 months, then become zero rated. So we now deleted that paragraph, which was transition, because the decision was changed to have maize flour zero rated. Because if you look at the updated VAT Act, because this zero rating was brought in Finance Act 2021, but that transition was not deleted. It was left now hanging, and that's what is being deleted now. Then the exemption which was provided for, it was up to read the paragraph which has been deleted on exemption, which is paragraph 108, which was exempted, is also being deleted. So we are deleting the exemption, also deleting which was in transition, so that it remains zero rated. And I think that should be very clear, and whoever is analyzing the look at it, goes to the Finance Act 2021 or the updated VAT, it is very clear what may remain is now zero rated. I think that percentage should go, that credit should go clear to all the stakeholders so that they don't come and bring an issue when you are discussing the finance, because they will be bringing an issue which has already been dealt with, and that was meant to clarify, to remove the transition and remain it as zero rated. So the maize flour as it is now, it is zero rated, but it was having 2 provisions, one zero rated transition and the exemption. So we are deleting the exemption, now it is zero rated. Another thing which I wanted to clarify is that county government, somebody has said that we are removed from zero rating and then we are going to make a tax, but no, you need to look the VAT in totality. When you are removing those exemption to zero rated to exemption, we transfer these to county government to be exempt, but we retain at the zero rating. So here we are not making taxable, we are now retaining at exempt status, not zero rated. So we are not going to make it taxable. I think you need to be clarified that one so that it does not give a mixed signal. Then another one which I've mentioned is anti-EBITDA. I think this is anti-avoidance provision. And if you're not avoiding taxes, you will not be caught up with this one unless your intention is to avoid paying payment tax in Kenya, and especially those who are operating in due to jurisdiction, Kenya and the foreign jurisdiction. We are trying to restrict deduction to ensure you pay the rightful tax to the Kenya government, but not deducting too much interest and declaring on the other side. Remember, what is expense here is income on the other side. So if you avoid payment of tax, you pay tax on the other jurisdiction. We are trying to ensure that you pay the rightful tax to Kenya by restricting deduction to the interest which you can, but now before you used to have this one, and this is EBITDA, which I think is more more updated in terms of international jurisdiction. Then you have mentioned about the digital service tax. It is true we have not signed, and why we have not done that is because the people advocating for signing and whatever they are bringing, we need to study to understand, is it going to remove our taxing right, or is it going to be better? Because we didn't sign, because when we introduce digital service tax, that's when the issue of the OECD tried to say we should not have it unilaterally, we should discuss as a group and see what it is. So we are studying the proposals, and that's why as we understand the proposals at the impact and what you have, we continue to taxing the digital tax. Until that time, we are convinced that whatever proposal coming at OECD is better for all of us. But otherwise, so far, we are still not made a decision whether to go OECD with, but we are still, because this request came when we have started our digital service tax, we need to continue as we understand to study, review what is being fronted for us. Another issue, which this was mentioned by the chairman of KAM about deposit of 50% tax. This is still another anti-avoidance. Our practice, or what we have seen, is that when a taxpayer has lost a case he continued appealing up to the Supreme Court. And in some instances, we find a situation where by the time the case is given determination, which may be after 3 or 4 years, where now we are told now you can go and collect the tax. We realize the company has reorganized, some assets have been sold, and we are saying, how do we safeguard revenue from this? But this is only after you go to the tax appeal rule in the favor of the commission. And that money is not used, it's a deposit in a special account, which we are also provided to be referred within that days, in case you go in the court of appeal. The essence is that you have found to have not paid tax, they have determined, they have gone to the tribunal, and the tribunal ruled in favor of the commissioner, it is payable. The chances are, we are saying, why do you give us a percentage? And in other jurisdictions, they request the full amount to deposit. But the Kenya, we say, let's go by 50 and see the response, and then maybe you can review upward or downward, depending on the circumstances and how compliant are taxpayers with the court decision, and even analyzing what are the possibility of that decision being overturned. Because if there is chance are very high to be overturned, then we realize we may not have a strong case of requiring that determination. But it's a good start to give a signal that you don't delay unnecessarily, so that you do another delay of paying the tax. So if I go back now to the tax, the question you have, what are the considerations which you have made into place? You can see some of those proposals. Others is protection of revenue, of safeguard the revenue which you have collected, and also addressing the concern of manufacturers. Most of those proposals, you may realize they stem from stakeholders, KAM and other stakeholders who have come and say, please, there is a situation here which requires to be addressed, in addition to promoting manufacturing. So in some of those key factors, like the export levy, it came from the stakeholders saying, please, we need to secure this input, we need to facilitate industries, which is putting a lot of investment in Kenya. The heightened scheme which is export levy, the concern is the industry is being affected by high export levy. We have not seen our tanneries coming up despite having that. Meaning that the people have tried to become more clever on how to avoid by misdeclaring. The issue is, how do we ensure we have the materials to the tanneries at the same time we are also not stopping the trade on those heightened scheme. And that's why we listen to the presentation from the council and the other stakeholders, and we see, let's see by reduction whether we are going to have more materials available to a tannery and not smuggling, which we were being informed, though we don't have facts on the ground, that is what is happening to avoid payment of high taxes. We have seen other provisions which, like when you are trying to ensure the taxpayer is concerned by him given an option, whether he wants to offset future tax ability without going the full audit. But this is purely on income tax, which he has overpaid. And overpaying of the income tax, unlike the VAT, which has your own provision, where it is input output, income tax payment is based on the estimate. And the likelihood you may overestimate. And when you're doing the actual account, you realize you have overpaid. In that circumstance, we are saying we allow you to offset future tax rather than going the full process of asking for a refund. It was addressed the concern saying by taxpayers, by manufacturers. I've done my estimate, I've done the account, and I've realized I've overpaid. How do you now subject me to the full audit, and like the input output where you have to verify the deduction is done properly? But that one does not preclude the commissioner coming later and audit and to verify that overpaid is genuinely an overpaid amount. Otherwise, we didn't want to close that window because the commissioner may come to verify and realize that overpayment was actually not an overpayment. It is just an error in your maybe filing the returns. So we consider those several factors, including promotion of industry, supporting of industry, like we have done, the pharmaceutical have supported them, and also in addition to addressing the concern of maybe, in addition to protect the industry, listening a few revenue here, because when you have no money, you have no money to invest in infrastructure. And the investment in infrastructure is very key supporting manufacturing. As you can see, there is a lot of investment in the roads here so that goods are able to reach the market and reduce the cost of that they incur if the roads are not well prepared. So few raising the revenue, few raising address the concern of the manufacturers, and few trying to improve tax administration so that they are able to collect more revenue and serve you better, so that they are able to, all of us are able to play our active role in the national development. I submit.
Thank you so much, JZ, for making some of those clarifications and also on your presentation. We move on to the next panelist, Dr. Duku.
Thank you, Job. We have Hadija from EY, a tax expert. And here is the question. What would you regard as the most punitive tax proposals contained in the Finance Bill 2022 as far as manufacturing sector is concerned, and why do you think you can consider them as such? Over to you, Hadija.
Thank you, Simon, and good morning, everyone. I'm smiling because I'm looking at JZ, and I'm exactly going to start from where he stopped in terms of the 50% deposit. And first of all, I want to submit that this is not the only country that is requiring a deposit. There are other countries, so it's not new, and it wouldn't be looked at as a unique scenario. Secondly, it is even better that it is done after the TAT. But the concern here for me, and why I think it's punitive, is that when we go back to the facts and the nature of audits and the structure and the practice that the Revenue Authority currently has, they are now probably looking at a certain way where they are being either efficient or faster in completing audits, so they don't have enough staff, where someone goes on the desk, they do a desk audit, issue a demand, and at that point where someone has not really got enough information to review, to engage a taxpayer, there's already a demand, there's already an assessment, it becomes very, very difficult when things have gone that formal to even take out or dismiss or even amend some of the huge demands that come up, which in my view may not necessarily be factual. So if that proceeds up to the Tax Appeals Tribunal and the Tax Appeals Tribunal rules in the favor of the KRA, it becomes very unfortunate and punitive to a taxpayer who is actually right. And that's why we see many cases coming out in that sort of structure and then ending up at the appeal at High Court and winning, because there were probably a few technicalities. So for me, I'm really looking at the level of maybe, can I say the procedures, the systems, the practice that is happening at KRA, and saying, if we customize it and we look at uniquely the unique structures within how audits are done and how these appeals come up, it may be very punitive, because I can attest that we have had many cases where someone has been given 2 billion as an initial assessment, and by the time it is ruled, actually that 2 billion was inexistent. So if you want 1 billion out of the 2 billion, and in such an economy it's bleeding and maybe it is not due, I feel that is punitive. So I will still submit that that may, in the current circumstances, and until we streamline and structure the way we perform audits, the way we deal with taxpayers, the way, I don't know, maybe if I use the word professionalism, all that, then this may really be punitive to a taxpayer. Then my second submission is on excise duty as a whole. I think the government has become so reliant on probably this is what they call, the government is calling a low-hanging fruit. because every time in the budget, we see where there is more revenue needed, the target is excise duty. And away from the sin taxes, what we traditionally call the sin tax or the sin excisable goods, the likes of alcohol, the soft drinks. Recently, we had water coming in. We had the financial services coming in a lot. The list is growing bigger and bigger, and it's worrying that at a certain point, excise duty may technically become a tax that is applicable to everything. Each time there's need for more taxes, the target is excise duty. And as if that is not enough, when we go back to the trend and the timelines of how this is applied, for instance, if we take a step back, just in October last year, the inflationary adjustment was applied. We are looking at less than a year. We are going to introduce another 10% and above in some instances to the same products that had been applied an inflationary adjustment in October, and I think it was 5.7%. And again, in July, I think there are some items last year that were applied an increment. So if the cow is being milked and milked and milked without being fed, I think for me, this is punitive and it will affect our industry. So generally, excise duty, I believe in 2015, we had a revamp of the act and it had very good provisions and all that. It was followed up by EGMS. It was then later followed up by the controversial regulations. It's quite a complex tax head, but when we keep increasing and not looking at the sectors that are affected, at times, for instance, let's look at the water, the common bottled water. I can also bottle water in my garage, but when we come to introduce excise stamps on that water at some point, how practical will it be? What is the nature of people? How will we simplify that? When we look at the new kid on the block in this bill, there's been a proposal to introduce excise duty on ice cream. We all eat ice cream when we take our kids to the football fields. There are people pushing those ice cream carts, selling ice cream. How are we going to target them for excise duty? Then at some point, it will seem like me, who is a manufacturer, who is structured, who can actually apply for a license and comply with all the Excise Duty Act provisions, I'm being disadvantaged from that person who is pushing, who is selling on a wheelbarrow or whichever structure it is, or someone who is in a kiosk. How do we target the two? So I feel like it's a bit punitive, and even if it wasn't, there's need to structure and look at the sector and how easy it will be to collect tax from that sector that is being impacted. Simon, I think you'll allow me to stop there for now because the rest have been exhausted. Thank you.
Thank you, Hadija, for highlighting that about the 50% requirement deposit of tax in dispute is a major area of concern for manufacturers and generally the excise tax regime in Kenya. Over to you, Job.
Thank you, Simon and Hadija. I now jump into Mr. Mihir's space, and I have a question. It's on tax burden. It seems that the tax burden, as you have heard, the other panelists talk about expanding excise tax base and VAT base and whatnot. And most of these is coming to the manufacturing sector. Manufacturing sector contributes about 20% of the revenues that are generated countrywide to the consolidated fund. What is your feeling about the tax burden for the manufacturing sector? At the same time, I'd like you to hear your comment on thin capitalization, or the EDITBA, the one that also JZ intervened or talked about a little bit, that is contained in the finance bill as part also of the tax amendments or enlargement of the tax base, so that the government can continue collecting more from the manufacturing sector as well as the other sectors. What do you feel about these two issues, Mr. Mihir?
Job, thank you very much. I will answer the second question first, because I just want to challenge JZ on his interpretation or on his comment. He did talk about, interest restriction and the foreign nationals or foreign companies not contributing or, taking much more amount towards interest and taking our money. But, this change which was introduced last year is applicable to all companies. Locally registered company, a branch, a PE of a foreign company. So it's not only applicable to only foreign companies. And this is a double taxation. What happens is, even the bank says, as earlier, EY team also mentioned that, the banks also pay taxes, local banks, and also we as manufacturers end up paying taxes, on disallowed interest portion. So there is some restriction is required. Most of the countries in the world where there is 30% restriction is applicable to foreign loans. Also, what we missed out as the grandfather rule, whereby, if your loan is already there when the rule was introduced, it should be exempted, which we missed it. As far as this year's budget is concerned, for this thin cap rule, what's coming out is, now in line with interest restriction rule, exchange losses will be disallowed. Now, again, this will be applicable to all companies, not only to foreign companies. So whether a company is registered in Kenya, domestic, PE of non-resident company, branch or subsidy, it will be applicable to all. 30% of the interest, if it is more than EBITDA, then the entire exchange loss will be disallowed and will be carried forward to a future period. Normally, what will happen is manufacturers, because of the capital allowances, they will not have enough adequate EBITDA because they claim capital allowances, and they will be affected the most, with this rule. And there is a need to review the entire section itself. Though, other places in the world, they are following this rule, but we need to review to suit our requirements. And it's really speaking, I personally feel it is a financial measure and not a revenue issue. I think we are mixing over the years. What I'm seeing is, as Treasury, we are mixing, revenue issue with financial issues. And that's where, the taxpayers are suffering most, because we need to segregate these two issues. Kenya is a territorial tax regime. And now, this kind of rules are becoming indirectly a worldwide income taxable. In a way, slowly we are entering into that regime, and we need to review it again. Coming back to second question, which was the first question for you, is burden on manufacturing. Personally, I feel, yes, this manufacturing sector is substantially taxed. But to me, rather than the tax rates, what we are seeing, what personally I'm seeing is the number of taxes. The number of taxes are increasing. Manufacturers, one or the other way, we have to follow 30 tax laws, 30 tax regulations. So administratively, it's becoming massive burden for the members. Every company has to employ someone who handles these tax issues. It's becoming very, very, burdensome. I think, all budgets, what I'm seeing over the years is more and more administrative measures are introduced rather than focusing on procedures, policies to expand the economy. It's just becoming more and more administrative issues. Then frequent changes, that's another issue. VAT exempt item becomes zero rated, zero items becomes exempted. More and more expansion of Excise Act, Income Tax Act also removing investment deduction, bringing it back. So many changes. I think, that's where the burden is coming to manufacturers. What we really need to look at it, what we really need to focus on is how do we make Kenya a hub for all multinationals, hub in Africa, so that they can come here. I think that's what we need to really focus, other than having more and more administrative issues. Look, we cannot reduce the tax rates because end of the day, government also need taxes. But how do we make it more simpler? How do we make it, more easier for taxpayers to operate in this country? I think these are my two comments. Thank you.
Thank you, Mihir, and also for making some clarification. I think have another session between KAM and the National Treasury and KRA so that we can deep dive on some of these issues, and then we can have a common position so that when we are presenting this to the Parliament, because this is the next stage, we are all reading from the same script. I want to go back to JZ with a sector-specific question that is looking into the glasses. There's a question regarding introduction of excise duty on locally produced packaging glasses. There is a precedent of a Tanzanian manufacturer going to the EAC tribunal and winning a case for exemption. And then we are seeing that the local manufactured glass is going to attract, I think, a duty of 25%. Yet, because of this win in the EAC tribunal, those who are in manufacturing in Uganda, Tanzania are not likely to attract these, are not likely to be charged this excise duty. Subsequently, you find that there will be unleveled playing field in the East African community. So JZ, what would be the best treatment about this excise duty, given that the local manufacturers of this glass are calling for the exemption of the local glass that is manufactured here?
I think that question is not straightforward answer which I can give, because we normally have this view. Excise duty is a domestic tax which have not harmonized across the region. And the reason which you could remember is because we targeted area the imported grass, not the grass. Therefore, they were saying they are being discriminated. But the issue is how we deal with our tax system. Domestic and VAT should not be considered as a regional issue, because VAT, for instance, in Kenya, we are at 16%. Others are at 20%. But they don't complain when you have a lower VAT than them. When it comes to excise duty, that company that went to complain was going on the pretext on we are now doing the discrimination. But when you try to harmonize the excise duty across the region, other partner states object to that harmonization. They want to continue or to have that sovereignty of adjusting their excise duty or levying the excise duty on various products, which is not uniformly agreed. We tried and we could not agree. So here we are in one kind of a situation. We have excise duty, which now we are saying, fine, let's put the excise duty without having whether it is locally or imported, so that we remove the issue of discrimination. As a way of now saying, let's raise some revenue from that. But as I said, this is not an easy option, considering there is always people who feel that whichever tax you have introduced is not in their favor, and they always come to complain. And at one time, so the rate, whether it is high or low, is also another subject for debate, because their main argument that is excise duty is going to affect their business. But my view is excise duty, when it is charged on both, it is a consumption tax. It's going to, unlike the income tax, where it eats on your profit. Excise duty, you pass over to the next person. And if you're able to pass over, depending on your capacity, on your visa and the quality, you're able to pass the whole lot of excise duty, unless have other issues which enable you now to share the burden of taxation. Instead of saying to consumer, you seem to have, and some you have solved. But in essence, excise duty and VAT are supposed to be tax neutral. Tax neutral in sense that it's not supposed to affect the decision of an investor, because that is not eating on his profit. It is supposed to be shifted, or a greater percentage supposed to be shifted to a consumer. So it's the consumer that bear the burden on VAT and on excise, although it all depends on how you are able to shift that burden to the other person. So in a way, it's a situation where I could say, I don't want to have yes or no, because of the circumstances of how it is, and coming from the EAC when they complain when it was put only on the imported goods. But here I've excluded the pharmaceuticals, bottles, because those bottles of pharmaceuticals, they have to, of course, in the universal healthcare, we have to support the manufacturing of pharmaceutical products and even the packaging materials, which is a regional support of our health or health in the region. They try to ensure, and this is where you have also a dilemma, where you have manufacturers of pharmaceuticals who want to have an import duty to protect themselves, to protect the manufacturing. But we as a government, we are now in a fix. How, if you protect manufacturers, what about the consumers who are going to have to be affected by that import duty? Expect the medicine if it's not available, and if the manufacturer increase the excise duty to match the imported product, who is going to affect the to support the consumer? And that's why that request we have not always accepted, because of that kind of a situation we are in. We have consumers, which is our customer, and we have manufacturers who are also our customers. And they all come to Treasury asking for protection. So that's how we try to balance the two. And I think on excise duty is an issue which I just wanted to mention, that when we introduce excise duty 2515, we introduce specific, most of the product, and a very few which are advertising. Some we introduce and specific, we quickly, after 2 years, we reverse to advertising because of the nature of those products. And then because we are creating unfairness, and this specifically the excise duty on motor vehicle. If you charge motor vehicle on basis on a unit, and you say, for instance, 150 per unit, you are unfair to the taxpayers who are importing different values. Some import a very high value motor vehicle, you pay 150. Somebody import a very low value, you pay 150. That kind of tax regime was not fair. And that's why we reverse immediately. And when we introduced, we feel that we did not put at the correct specific duty. And that's why we keep on adjusting. And just for VAT inflation, it's just to catch up with the change of the economy of GDP rate. But the adjustment was meant to ensure we try to come closer to the rate we could have desired if we had put advertisement. That's why it was adjusted. And I had somebody mentioned about some product were adjusted, was just not last year. I think it was 2018, if not 2019. So there's some years before it has been adjusted. And specific duty, if not adjusted, you lose the absolute value of the tax you are supposed to collect because of changes in the economy and environment. Unlike the advertisement, which changes, which continue getting, unless it was put very low. Some rate were put a very low because it was being introduced, and that's why they were being adjusted to match what we would have desired to have. I remember somebody was complaining about the capital gain tax, and the intention why it was being proposed is that our initial intention, if you look at the finance bill when we were introducing, it was not at 5%, it was at 10%. But our discussion with the member of parliament was reduced to 5%. So we are having that desire to adjust to the level that we wanted to have it. But that's why we are also proposing again, hoping the parliament will be able to now to listen to us and consider the adjustment. But in most jurisdictions, capital gain tax is taxed at the same rate with the corporation tax. There is no difference. But in Kenya, we didn't want to go to jump to that %. We just increased to half of that %, because it having a difference, it might bring the issue of recapitalization of the income. Instead of putting together as a corporation, they just separate it as a capital gain to pay at a lower rate. So some of these things are brought because of the practice where you have seen some people are trying to create a situation or avoiding paying the taxes. Though it may be legal, but we find that if it was put properly, it would have attacked the 30%. So we are trying to say we need to have a way of ensuring we cap all the avenues of people trying to classify tax to where they can pay at a lower rate and submit.
Thank you. I can see Ephraim's hand is up. If we want to have some further comment on the same.
Thank you. I would have loved to, I lost my connectivity at some point, and I would have liked to comment on the 50% deposit if I'm allowed.
Go ahead.
Thank you. Thank you. Sorry for that disconnect. Now, I do take note, or the positive note of what Madam Hadija said, which was very good with regard to the 50% deposit. She appreciates that we are not the only country that has that amendment or that provision, and that is a very good approach to the amendment. And then, further to her comment, she did bring out the fact that quite a lot of assessments do emanate from KRA, which are not to the standard, or which are not well probably analyzed or reviewed and the like. My only observation is that, my key observation is that this amendment is hitting hard on both of the sides, both the KRA and the taxpayers. And it is my considered view that we need to raise our stakes, all of us, those who are supporting the taxpayers and the KRA. Why? There are 3 levels, or rather 4, which are important to this process. One is the inquiry stage, at the point at which the taxpayers have the opportunity to give the information and clarify to KRA. Then there is the objection stage, at the point at which the taxpayer has the opportunity to still clarify and convince the commissioner that, or KRA, that the assessment is not correct, or either 100% correct or 50% correct. Then there is the TAT, the point at which, again, the dispute is reviewed by a higher team and competent team of members of the TAT. And within all that, and even at that level, there is the ADR, which still is a further window or bypass, which would enable the matter again to be reviewed by both the teams at when it is still at the TAT. So what is coming out is that now, with the requirement for the 50% deposit, both teams have got to go back to the drawing board and ensure that what they are putting on the table is very correct, so that even the commissioner himself doesn't get embarrassed or frustrated at defending or putting across the assessments which are all rejected, demanding, which get to the high court level, 50% deposit is put in, and then the commissioner loses and continues refunding back and back from the fund. It would be a very key pointer to the effect that the assessments are not up to date. So I take cognizance of the fact that it's a positive move, and that Hadija did accept, but there is room for both parties to firm up their positions before it gets to that level, such that when it gets to that level, the taxpayer is ready to part with 50%, the commissioner is ready to defend. Thank you.
Thank you, Ephraim, and thanks also for noting that we need to have further discussion on some of this to help all of us who on this call trade from the same script that is supportive of the industry. I want to go back to Mr. Odua and ask about the major allocations that are going to, like now, the special economic zones or the EPZs. You find that in the recent past, the government has been allocating funds to SEZ programs. So the question is, are the SEZ and the EPZ game changer as far as the Kenya industrialization is concerned? Are they the solution to Kenya's narrow export base and the growing trade deficit? Mr. Odua.
Yeah, thank you very much, Job. Indeed, the special economic zones, the export processing zones, are actually initiatives that we believe as government are major change players. If I just take an example of the EPZs, for example, within the EPZs currently, we are having, just as that alone, export of about 80 billion. That's in the year 2020. Making us the largest exporter of garments from sub-Saharan Africa into the US market under the AGOA provisions. So we also see already with the 14 licensed special economic zones, the level of investment being brought into the country is also quite high. You find, for example, just for the 6 developers, I mean, that city that is already complete, Konza, another ones, etc. You could find investments over tune of $598 million US. And if you look at the investments in terms of the licensed SEZ as well, you find that already for the 14 that have been licensed, we are talking of investment levels of over $189 US. So looking at the experience and the success of the EPZs, and now we bring in the special economic zones, which actually provides even a wider range of products and services, we see that this will definitely be the route for us as we look at expanding our export base. If we look at just, again, the ESC, for example, you look at the structure of the ESC in terms of the type of industries. If you look at the agricultural base that we all equally have as a region, the differentiator now will be on which of these manufactured products are we trading across board. We all have coffee, we all have tea, cotton, etc. But what are these manufactured products? So this would definitely be a game changer in terms of expanding our export base in terms of product facility. And also as we move into the African Continental Free Trade Area, as we exploit the opportunities within COMESA, we'll only be able to increase our inter-Africa trade through manufactured products. Thank you very much.
Thank you, Mr. Odua. We go on to Dr. Iluko.
Thank you, Job. We ask a question from the chat to KRA team. Please be ready. Would the digital marketplace measure be applicable to all goods and services sold through a digital platform, i.e. groceries acquired through a digital platform? It's a question from anonymous participants. Any of the KRA experts, Ephraim, Josephine, or Dr. Kirui, you can feel free to respond. Josephine? Or Bernard or Ephraim, the one on the chat, Q&A. Would the digital marketplace measure be applicable to all goods and services sold through a digital platform, i.e. groceries acquired through a digital platform? Yes, Josephine.
Please repeat the question again. Whether the digital measures is applicable to?
Would the digital marketplace measure be applicable to all goods and services sold through a digital platform, i.e. groceries acquired through a digital platform?
It will be applicable to everything that is vatable under the law. So anything that is exempt in the law will still be exempt here. But the digital marketplace is the service. So for the products, whatever is vatable will have been vatted as you purchase. But the digital market will focus on offer of the service. So if we are talking about offering of a service through the digital platform, then that will be vatable. But the products will only be vatable as laid out in the VAT law.
Thank you, Josephine, for the response. I hope this clarifies the question by the member. Now to Hadija. Here, KAM director indicated the growing tax burden on the manufacturing sector. And based on your experience, how can you, what other measures can the government institute to mobilize revenue to fund the expenditure?
Thank you. I think I want to first say that when we look at Kenya and East Africa, the major sources of revenue are debt and tax brings the majority of the revenue. And that is a principle across almost everywhere. But when we unpack the tax bit, I think there is more we need to do in terms of ensuring that we go by fairness, we go by it being equitable so that everyone pays. There's been a big outcry on the informal sector, that the informal sector could have been missing out. And what I want to bring out very clearly is that every one of us pays tax. And why I want to bring that out clearly is that when we look at indirect taxes, the excise duties we are talking about, the VATs of this world, the import duties, those are taxes that are borne by the final consumers, meaning that indirectly, even that person in the informal sector, he's buying a cigarette, he's buying a wine, he's buying a soda, and so on. He's indirectly paying tax, but the area of concern is more on the direct taxes, the income taxes, pay as you earn, corporate tax, for their case, some of them turnover tax or presumptive advance tax. That is where the government probably could try and put more effort, try and re-engineer. They've tried turnover tax on the informal sector. There's been a presumptive tax at some point. There's been advance tax, but still we are not seeing the impact it is supposed to create, which means something is not right there. And I think even the government must admit that they are struggling to see how to penetrate the informal sector. But the fact is, the formal sector is really being, it's really being choked. It is being choked, and I think it will get to a point where the government cannot generate any more revenue out of them. They've got what they should. So it's high time that we looked at re-engineering and developing efficient and effective methods to tax the formal sector. Then the other one is on non-tax revenue. I think we are getting so little from non-tax revenue. When we look at the concept of the county governments that we adopted a few years ago, the question is technically, practically, county governments are supposed to generate their own revenue, and they're the ones to kind of spearhead bringing in the non-tax revenue. So I also feel like not much is happening there. So we need to focus and see that we revamp and streamline collection and accountability for taxes in that area. Then the other area I think we can look at is the area around PPPs, private-public partnerships. We know government struggles to think or act like a business person. So in terms of making money, bringing in revenue, and also areas around the debt we are struggling with, the country is struggling with the high debt. But why would the government be going out to get that debt, and yet there's private sector that it can partner with and reduce on the burden that debt brings? So even when we are looking at infrastructure and the allocations that go into it, and the fact that most of the financing for that comes out of debt, we can look at PPP to work on that and reduce on that burden. Then in the longer term, we may also consider lowering the tax rates to enhance compliance and therefore look at a bigger cake. Part of the reason probably why the revenue is not much could be attributable to the fact that the tax is complex, the rates are high. As everyone, we've been talking about the 50%, there are 25%, there are 35%. There are so many tax rates around which are being perceived as high. So if the government looked at the phenomenon of the Laffer curve, where you reduce taxes, increase compliance, and then get a bigger base to tax, that could also help increase revenues without people feeling the burden, because the burden will be shared by everyone. Then maybe lastly, to give a chance to other participants, I think like I've been saying, that we milk the cow without feeding it. I think the economy needs to be fueled, because when we honestly look at it, where does the tax come from? When you have a cow, it can only produce milk when you feed it. Can the government try and fuel the economy, especially boosting productivity in the agriculture sector? Let the allocations be there, let them be accounted for properly, let the money be put to good use. We boost productivity, then there will be people to tax, there will be profits to tax, there will be people with disposable income to spend, and then we get the VAT, the excise duty and all that. It will be a vicious cycle which will not be belabored so much. I think I can stop there to give others to give their comments. Thank you.
Thank you, Hadija. And KAM partners in tax matters, Ministry of Industrialization, National Treasury, KRA, you have had what other options you have you can have to grow revenue to further public expenditure. Over to you, Job.
Thank you so much, everybody who is on this call, especially the panelists, the speakers. We have several set of questions that have been raised. We don't have time to answer them. Questions that are coming from Engineer Kari Baraka on the VAT exemption, VAT input exemption on the raw materials used in manufacture of passenger vehicles. When the other question is coming from David Wabuku on the raw materials used on as the resins are raw materials used as intermediate for manufacture of paints, and why this is being imposed on the local produced and imported resins. What I was proposed is that Kadre ask these questions you can type this question directly into my email. I'm going to link up with the National Treasury and the KRA and Ministry of Industry and get back to you. My email is job.wanjohi, WANJOHI @kam.co.ke. We are going to respond to this because of time. We are at 12:04. Our intention was to start to stop this webinar at 12:00 at noon. So we have gone beyond by 4 minutes, and I propose that you give me a chance to make 3 minutes closing remarks and the vote of thanks. The webinar went on well. We have had extensive discussions coming from both sides. The participants and also the attendees and also the panelists. And I've noted that we have even some questions that we have not been able to answer because of time, but I promise that we are going to do these via email. So I want to thank all of you, those who are participating in this webinar. Speakers talk of the panelists, starting with the board chair, Mr. Mushai Konyiha, coming to Mr. Steve Odua, also Mr. Robert Minor, and the panel, including Mr. Mihil Shalishaza, Mr. Stephen Odua, Mr. Jezet Gugi, Ms. Hadija Nanyomo, and also the KRA representative, Josephine Mugure, Dr. Bernard Kirui, Mr. Ephraim Munene, and Ms. Nere Okwach. We are very grateful because of the presentation that you have done this morning. They have enlightened the KAM members who are present on this call as far as what is contained about the statement in terms of allocation, in terms of expenditure, in terms of revenue, and also the legislative proposals that are coming through the Finance Bill 2022. We are encouraging all the members present and those who are not present, KAM members, that you submit your feedback, because you can see various concerns that are coming. So that you submit your feedback to the legal team in KAM by 22nd of April 2022. We have a circular that is issued by the Parliament that by 4th of May, we ought to have submitted our memorandum to the National Parliament for their consideration. So we want to have enough time to be able to prepare the memo, validate it through the legal team and also Tax and Trade Committee and various other channels that we involve procedurally within KAM. We'll also have another webinar on now the Finance Act and also EAC legal notice, that is in July 2022. So that now we can count on the wins, the gains, whereby we have the losses, and now start engaging on the post-Finance Act 2022 research and advocacy engagements that are going to lead to post-budget statement and post-Finance Act policy budgetary proposals. So I'm going to encourage all of you to participate in this webinar, and it's going to be announced probably in the month of June, so that we have it in the early in July. One thing that I'm going to guarantee all of us as KAM members is that we are going to continue giving the full support as a squad as far as some of these policy and taxation measures are concerned. We're going to share with you the link of this webinar for those who are participating on this call and those who are not present, so that you have a chance to refresh your mind as far as listening again is concerned. Thank you so much, and we have come to the end of this webinar. Have a lovely afternoon.